Okay, hi, good evening, everyone. So thank you all so much for coming down today to join us for actually our first live event in 2 years. So I haven't spoke on the mic in 2 years as well, so I'm terribly excited to see all of you here as well. So thank you for coming down, and I know it's been raining as well, so thank you for making that trek. So really quickly before we start, just a quick introduction to today's topic. It's on financial planning and investing. What we'll do is I'll take you through a couple of basics about how you can get started. So if you have no previous financial planning experience or investing experience, today, this will be a great way to help you get started. My name is Amanda, and I'm the country manager for StashAway in Singapore. I essentially head our Singapore business. I've been with the company for close to 4 years now. Essentially, first of all, leading our client experience team, which is the team that handles our entire client base. And I've been doing a lot of these seminars quite a bit over the past 4 years. We have actually created an Investing for Women curriculum. So if you've previously attended one of those sessions, you would be familiar with today's content as well. So next slide. Okay, so really quickly, we also wanted to introduce why we came about or why we started She Invests by StashAway. So what we have always done is really focus on financial education. And actually, She Invests is an extension of our financial education arm, StashAway Academy. So as I mentioned earlier, we created an Investing for Women curriculum, and this is kind of an extension of it where we want to go deeper. And we have over the next 4 weeks a masterclass series. Obviously, this is just the start, and we do intend to kind of keep this going over the next year or so. All right. And what we're trying to solve is really the gender investing gap. Okay. And so compared to men, women actually tend to live longer and defer their financial planning decisions to their spouse. Right. And this becomes quite a bit of a problem when you think about it, because women live longer. If you defer your financial planning decisions to your spouse, you end up with a situation where you might outlive them and have to deal with the finances and not know what to do. Right. So what we're trying to do today and over the next couple of weeks is really empower you with a lot of the kind of tools to be able to make these decisions yourself. All right. And what have we done to obviously try and solve this gender investing gap? This is the masterclass series that we've launched. And we hope that over the next few weeks, it will be useful for you to take charge of it. So what we wanted to really quickly start off as well is to look at some data, right? So this is what I mentioned earlier, right? Women tend to outlive men. As you can see, on average, we tend to outlive men by 5 years, right? And it doesn't help that there is quite a bit of a gender pay gap. Okay, so as you can see, this is ranked by countries. It tends to be the widest in countries like Korea. But this is the case pretty much, around the world as well. And there is also that gender confidence gap, right? So as I mentioned earlier, women defer their financial planning decisions to their spouses. And some of the commonly cited reasons for doing so is, first of all, that they lack the knowledge, okay? And secondly, they lack the interest, right? And a lot of them say, for example, that, perhaps their spouse is the sole breadwinner of the family, or perhaps they know about it more than they do. And that's why, they should go ahead and make those decisions. But that is obviously a dangerous kind of pitfall, as you'll see over the next couple of slides. So what can you do now? Take control, right? And what we're going to do today is kind of take you through the financial planning process. And before we jump into that, let's define what financial planning is, right? Financial planning is the process of meeting your different life goals through a very disciplined and systematic approach. So essentially, if you are getting your salary every month and then just kind of saving whatever is left after you spent everything, that is not financial planning, right? Financial planning is when you think very consciously about how much you're going to set aside for investing, how much are you going to set aside for your different financial goals. So this is the 5-step financial planning process. It's a very similar process that our wealth advisors at StashAway actually take our clients through as well. And what I'm going to do today is take you through each of these steps so that you can look to implement them yourself. All right. So to begin, what we're going to do is to determine your current financial situation. Okay. And what you want to do is to take inventory of all of your assets and liabilities. And you can do this through, a very manual approach by taking an Excel sheet and listing all of them down, or you can work with an app as well, right? Right nowadays, there are a lot of mobile apps that actually helps you calculate your net worth very, very easily. So these are some examples of financial assets that you might want to take into account. First of all would be your cash in the bank, right? So whatever amount it is, you want to list the cash value of your cash in the bank in that Excel sheet. The next thing that you might want to include is if you have a pension fund. So in Singapore, if you have CPF, you want to make sure that you include that as well. If you own any real estate, right, any investment properties that you own, you want to make sure that you include that dollar value in your assets as well. If you have a stock portfolio, unit trusts, investment-linked policies, or even a StashAway account, you want to make sure that you include all of those dollar values under financial assets. Okay. And the next thing that you want to do, so financial assets is essentially things that you own, right? Things that actually increases your net worth. Liabilities, on the other hand, are things that you owe that you've not paid off yet, right? And these are a couple of examples of liabilities. First of all would be your credit card. So the most obvious one is obviously if you don't pay off your credit card in time, you start to accumulate a credit card loan. Or one thing to note also is that whenever you tap your credit card, that's money that you already owe that you've just not paid off yet. And that would also go under liabilities, right? If you have any personal loans, so student loans, car loans, loans that you take out for a wedding, for example, that would all go under personal loans. If you have a standing instruction or gyro site set up for your taxes to be paid, that would also go under liabilities. And if you have a mortgage as well, that would also go under liabilities. Okay. And how you determine your current financial situation is to essentially calculate your net worth, which is basically the difference between the total assets minus the total liabilities, right? And as you can see, based on this equation right here, obviously, the higher the amount of assets that you have, that goes to increase your net worth. Liabilities actually goes to reduce your net worth, right? So what you want to try and do is either work towards increasing the amount of assets that you have. So these can include cash in the bank, for example, or reduce your liabilities, which are things like spending, right? So why do all of the expenses matter, right? Even the little ones when you are calculating expenses and working out your net worth. Well, these are a couple of examples of that, right? So if, for example, before going into the office every day, you like to go get a Starbucks coffee in the morning, and perhaps, that Starbucks coffee costs you $4.50, right? If instead of spending $4.50 on that coffee, you decide to go into the office and get the coffee in the office instead, over a period of 30 years, that amount invested actually accumulates to more than $133,000, right? And to give you another example as well, for those of you that own a car, in Singapore, owning a car is very expensive, right? And if you own a car, you have to think about petrol, you have to think about, taxes, insurance that you have to get. And let's assume instead of getting that car, you decide to take the bus or the train instead. And you save about $1,000 every month. Well, $1,000 every month accumulated and invested over 30 years, that actually grows to $1 million, right? And finally, one last example, for those of you that rent in Singapore, perhaps you have a couple of options. One that is right by the Marina Bay with a beautiful view over the bay, and one that is perhaps a little bit outside the city center. Okay, and the difference between that rent is about $500. $500 that you save every month and invest accumulates to more than $220,000 over a 20-year period. So obviously these amounts are quite substantial and can really, really make a difference towards your retirement savings, right? And this obviously helps to put everything into context for those of you that are thinking about working towards saving $1 million, let's just say. Okay, so this gives you an idea of how much money you need to save every month to be able to get $1 million by age 65. Okay, so if you started at age 25, for those of you that are fresh graduates tuning in right now, okay, if you started at age 25, you would only need to save $490 every single month to be able to get $1 million by age 65. But if you only started saving at age 35, that number more than doubles to 952. And if you only started saving at age 45, that number actually more than doubles again to $2,000 over dollars. And the reason that it more than doubles over time is because the earlier you start, the earlier you get to benefit from the effects of compounding, right? And one thing that I hear a lot from people is that, they tell me, Amanda, when I'm 45, 55, I'm going to be earning way more money. I'm going to have a high-flying career. Saving $2,000 or $5,000 is not going to be a problem. But one thing you have to think about is that when you are in your 40s and 50s, you're probably going to have a lot more dependents, a mortgage to pay off, a lot more responsibilities that could also make, saving $2,000 a lot more difficult as well, right? So the first step earlier, as I mentioned, is to determine your current financial situation. That is to first of all take note of your net worth, and then also obviously keep track of the level of expenses that you have, because this goes towards helping you determine your net worth over time, right? The next step is to develop your financial goals, okay? And we have, obviously, everyone has a couple of different financial goals. You have your own kind of financial goals that you're working towards. These are some examples here. And we have, obviously, this is just a recommendation from us of how you can look to prioritize these goals. Okay. So what we will recommend, first of all, is to prioritize paying off debt. Okay, so the same way as I mentioned earlier that, the compounding effect of interest can work for you, it can also work against you. So you want to make sure that if you have any debt, you have any personal loans, you try and make sure that you pay it off in a timely manner and as soon as possible, right? The next thing is to ensure that you have a safety net or an emergency fund in place. Okay, so essentially what we typically recommend is to have at least 3 to 6 months worth of expenses in an emergency fund. And you want to make sure that it is kept in a savings account or maybe in a cash management portfolio, something that is very liquid, very, very low risk. Okay. And the reason that an emergency fund is very important is you want to make sure that in situations where, because of COVID, people might lose their jobs, or perhaps you have an unexpected large expense to make, you don't have to draw down on your investments, for example, right? You have a deposit of cash that you can tap into over a period of time, right? And the third thing you want to look to prioritize is retirement. And I'm going to explain in a bit why, looking into your own retirement is super important, but that's the third goal that we're going to recommend that you work towards, because it's probably going to be the most expensive thing that you save for in your life, right? And then after that, you can look to prioritize whatever other goals that you have. And you also want to make sure that you have a goal to just enjoy yourself, right? Setting up a budget that you are, comfortable with every month to, go to the nice restaurants that you want to go to, buy the nice pair of shoes that you want to get, right? Setting these budgets and goals explicitly makes, obviously sticking to your financial plan a lot easier. So drilling down into retirement, as I mentioned earlier, it's probably going to be the most expensive thing that you spend on in your life. If you think about it, it's that one period of time where you're no longer contributing towards your savings, but you're essentially drawing down on your savings, every single day, right? And you're working towards, in your working age, you are working towards saving for a certain amount so that you can retire carefree, right? So some people call it retirement, some people call it financial freedom, which is essentially the ability to live the lifestyle that you desire without having to work if you don't want to, right? And this financial freedom can be achieved even before the retirement age, the typical retirement age, right? Some people want to achieve financial freedom at the age of 30. Some people want to achieve financial freedom at the age of 40, right? And that that's obviously up to you. But the most important thing is to understand what is the amount that you're working towards, and then you can work backwards and start saving today, right? So what contributes to a happy retirement? And there are 4 main pillars to that. The first thing is, in Singapore, it will be a CPF or a pension plan that you can tap into during your retirement. The second thing is, a house over your head, right? A roof over your head. So you want to make sure that hopefully by retirement, you would already own the house that you live in, you've paid off your mortgage, and you don't have to worry about it anymore. The third thing, especially in retirement, is obviously as we get older, we'll start to have potentially a lot more medical problems. And so you want to make sure that you have extra medical coverage in retirement as well. And then lastly, you also want to make sure that you have a good amount of investments, both obviously as you're working towards retirement, as well as when you are in retirement, okay? So one misconception that a lot of people have is that once they get to retirement, they essentially sell everything and move it all to cash, right? And if you think about it, you're probably going to live for at least 10, 20, 30 years. And that's actually a very long investment timeline, right? So you want to make sure that you have a good mix of capital protection at that period of time, as well as capital growth, okay? So that's what we mean by investments over here that helps to contribute towards a happy retirement. So drilling down a little bit on investments, what should you look out for when you're making investment decisions? And we're going to touch on it quite briefly here. Just certain things that you should keep in mind as you are looking to select different investment products. The first thing is that you want to take note of your investment timeline. right? So essentially your investment timeline is how long are you looking to invest before you would like access to the cash. So if I'm saving for retirement, my investment timeline is a long-term one. It's probably 20, 30, 40 years. And let's say I'm also saving to buy a house in a few years, then my investment timeline is much shorter. Okay. And your investment timeline will determine your risk level for your portfolio as well. So it's very important for you to understand that. And the second thing to keep in mind is your risk tolerance or your risk appetite. Okay. And this is a very personal preference, which is why, honestly, it doesn't make sense to ask your friends or your family what they're investing in, because they are going to have a very different risk appetite from you. Right. And this is something that's very important to keep in mind, because, oftentimes I see clients that evaluate an investment products based on the returns that they're going to get, and they don't look at the amount of risk that they're taking. Okay. And what happens is that when markets start to get a little bit volatile, they are kept up at night, they're panicking, markets go down 20%, and they potentially sell at the worst possible time, which is when prices are at its lowest, right? So choosing the right portfolio for your risk appetite helps prevent that from happening. So this is a quick example of that. So we have two individuals here, Rachel and Mark, and they both have a goal to retire in 30 years. Okay, so a very, very long-term investment timeline. And let's just say that Rachel is generally a more aggressive investor. Okay, and Mark is just a more balanced conservative investor. That's just his preference. Okay, as you can see, for the both of them, for their retire in 30 years goal, because Rachel is generally a more aggressive investor, she's comfortable with taking on more risks. She has chosen to allocate more to growth-oriented assets as compared to Mark. Okay, so essentially, in general, what's important to keep in mind is that the longer your investment timeline, the more risks you can afford to take, because you have obviously enough time to ride out the short-term volatilities in the market. So you have enough time to ride out the market corrections as well as the recessions. However, if you have a short-term investment timeline, you want to make sure that you adjust your risk level, because you don't have enough time if a recession happens. Okay, so this is what I mean by that. So as you can see, for the both of them, even though they have obviously the same goal, they have very different risk appetites and therefore very different asset allocation. So for the both of them, Rachel has first of all allocated a much larger allocation to growth for a retire in 30 years goal. But for a buy a house in 3 years goal, she's reduced that allocation to growth-oriented assets and increased it to protective asset classes. So protective asset classes are things like bonds that tends to be less volatile over recessions or market volatilities. Okay, for Mark, he is very similar to Rachel as well. Due to a shorter investment timeline, he has also reduced his allocation to growth-oriented assets. All right. So the third thing to keep in mind after you've evaluated your investment timeline as well as your risk appetite and chosen the right portfolio based on that, you want to make sure that you also build a very diversified portfolio. So essentially not putting all of your eggs in one basket, right? And this is, I think, a great example of that. So for those of you that remember what happened during the 2008 global financial crisis, right? We had in the US what is called a real estate bubble. Okay. And essentially, people that were not very credit worthy were able to get loans. And, what happens when a lot of people are able to get loans is that they start buying houses, right? And so there was a lot of demand for real estate in the US, and they started driving prices up. Okay. And over that same period of time, gold was not doing well prior to the crash. Okay. So gold is typically considered a flight to safety asset. So when there's a lot, when markets are stable, when, equity markets are doing well, people don't like to go into gold because in itself, it doesn't pay you any dividends or interest, right? But what happened after that is that the real estate market, the bubble burst, right? All of the prices crashed, as you can see. And over that same period of time, gold went up. Right? So people started going to that safety asset. What we're trying to highlight here is that if you look at it very simplistically, if you had 50% of your portfolio in gold, 50% of your portfolio in real estate, some of the gains from gold would have helped to buffer some of the losses from real estate, right? Obviously, don't build a 2 asset class portfolio, right? You want to make sure it's more diversified, but this is just to highlight the idea, right? Some of the gains in your portfolio would help to buffer some of the losses if it is very diversified. right? So this is an example of what a diversified portfolio could look like. These are examples of actually our actual portfolios on the StashAway platform. So you want to make sure it's diversified across different regions, different asset classes. You have bonds of different maturities so that you can play around with the yield curve as well, right? So you want to make sure that it is very, very diversified. And the last thing to take note of is also fees, right? So this is something that is super important that, perhaps your financial advisor or your banker might not be super explicit about. And you want to make sure that in every scenario that you're asking the questions of what fees might I have, what might I be exposed to, right? So these are some of the fees that you might want to take note of. The first one is an entry fee. So an entry fee is actually very typical of a lot of unit trusts and mutual funds. Okay, so they basically charge you a percentage of your capital right away. So it could be about 2.5%, let's just say, and only the remaining 97.5% actually gets invested for you. Okay, so that's an entry fee. The next one is a management fee. So this is quite typical of a lot of fund managers. They charge you a percentage of your assets under management. The third one is your transaction fee. So if you have a brokerage account, every time you buy or sell, you might be charged a fee. And if you have a brokerage or investment account, certain platforms actually charge you a platform fee as well. And the last one to take note of is an exit fee. Okay, so this is, where if you're looking to withdraw, you might be charged a withdrawal fee, or let's just say you have a certain lock-in period. If you want to withdraw early, you might be exposed to penalties as well, right? And you want to make sure that as much as possible, you avoid this because the inflexibility is also a cost to you, right? And then lastly, you have the X fee, which is a fee that might not be super obvious in the beginning. Make sure, as I mentioned, that you question whoever's trying to sell you an investment product, what fees you might be exposed to when you're investing as well as when you want to withdraw. All right. And this is just a quick example of why fees really matter. As you can see, we have two investments here, investment A and B, both of which I invest, let's just say $2,000 every month. They both give me the same return of 6%. The only difference is one charges me 0.2 to 0.8% of my assets under management annually, and investment B charges me 2.5% entry fee every 2 years and 1.5% annual. This is actually a very typical unit trust fee structure in Singapore, and that means every 2 years you're paying 4% in fees. If you earn 6% in returns and you pay 4% of fees every 2 years, you're only getting 2% of returns, which is hardly beating the rate of inflation, right? Over a 30-year period, that is essentially a $600,000 difference, which is a huge amount when you think about it during retirement, right? It can mean the difference between you going to Italy every year during retirement and you watching Italy from your TV, right? So you want to make sure you take note of that. And the last thing that we want to quickly also talk about when it comes to investing is whether, a lot of people ask us very often is when is the best time to invest or when is the best time to exit the market? When you're essentially thinking about the best entry and exit points, you're trying to time the market. And so is there ever a bad time to invest? Well, if you have a long-term view, the short answer is no. Right? And this gives you an idea of why. There are two main reasons for it. The first reason is that typically the worst and best days in the markets are very close to each other. So when you're trying to time the best days to enter or exit, it's very difficult for you to do so. The second reason is that ignoring the noise is challenging. So whatever the financial media is saying, obviously they're trying to sensationalize the news, sell newspapers. Ignoring all of that noise can be challenging at times. So this is a quick example of what I mean by the worst and best days are very close to each other. The green dots are the best days in the markets, the red dots the worst. As you can see, they're very closely cluttered together. And this is an example of what I mean by ignoring the financial media is very challenging. This is in March 2019, right after 2018, where we had two market corrections. As you can imagine, everyone was not very optimistic at that point in time. And these were actual financial media headlines in March 2019. And what you see on the line there is how markets performed over the same period of time, right? So the third step after you've developed your financial goals, looked into investing to obviously make the most out of your savings, the third thing is to implement your financial action plan. right? So you want to very quickly pick your goal for implementation. Okay, whatever goal are you're trying to save and invest towards. Review your monthly budgeting. So how much are you saving every month towards that financial goal? Utilize your preferred savings platform. Okay, try and automate it as much as possible. And if in any particular month your budget is less than a needed amount, don't worry about it, right? Oftentimes that happens and people start giving up. Don't do that, right? You just make sure that you can make up for it over the next couple of months. And lastly, just start, right? Start today. You can always revisit and adjust the amounts later on. The first thing, so the first 3 steps we mentioned is what we call the financial planning. If everything goes as planned, you do the first 3 steps. What you want to also make sure you plan for very quickly is your financial plan B. So alternate courses of action if things don't go as planned. Right? So the first thing is to set up a will, and you can actually do that very easily right now online. And you can do it in a very cost-efficient manner as well. Setting up a will is very important if you want your assets to be distributed the way that you wish, right? And I'll give you a quick example of that. If you don't have a will in Singapore, your assets will be distributed under what we call the Intestacy Act, okay? And it has set rules of how your assets will be distributed, typically to your direct family members. But if you have certain wishes, sentimental value of giving, maybe a watch to a friend or something, obviously it will not be distributed based on that if you don't have a will in place, right? The next thing is that you want to have, if you have perhaps a wish, do not resuscitate wish, you do not want kind of extraordinary measures taken in the event of a medical emergency, you can have what is called advanced medical directive in place. You can also put in place a lasting power of attorney if you want to assign certain powers to perhaps family members that you trust in the event that you're no longer able to make those decisions yourself. And then lastly, also you want to have in place life insurance. So life insurance is both important for your dependents, right? If you are the sole breadwinner of the family, it becomes very important. But also if you're not, because typically with life insurance, you have what is called the total permanent disability and critical illness rider, both of which are very important for even, those that do not have any dependents, where you actually get a lump sum in the event of, you getting disabled or getting critically ill. Right. So these are some of the important things to keep in mind. I'm touching on it really briefly here, but we actually do go really in depth about these 4 topics in our financial plan B session, which you can actually watch on the StashAway app right now. All right. And then the last step, I'm just mindful of time because we do want to move on to the panel, is to review and revise your financial plan regularly, right? So you want to make sure that you review your financial plan at least on an annual basis or when significant life events happen, right? If you get married, you have a new kid, you want to make sure that you account for all of these things into your budget, as well as also making sure you account for these things in your overall financial plan. So your will, your life insurance policies, etc. Right? And you want to revise the plan, as I mentioned, on the most updated data. And every time you implement the step, celebrate that, right? And obviously, if you reach a financial goal, also make sure you celebrate that. It makes the obviously entire process a lot more manageable as well. All right. So that's pretty much it. These are some of the key takeaways from today. First of all, you want to make sure you know yourself. So know your financial situation, calculate your net worth, and create a budget for yourself. The next thing is to have goals, right? Identify your financial goals, rank them based on what's most important to you, and calculate their financial cost so that you work towards that particular amount, right? And then lastly, make sure you have enough coverage. Be prepared for life events, have appropriate insurance coverage, and keep your plan up to date. All right. So that's pretty much it. This is a quick summary of what I mentioned earlier.
My name is Kimie Rasmussen. I'm the head of wealth advisory for StashAway. Right next to me, we have Nandini, who's our COO. Of course, Amanda now, and then we have Uthra, who's our Chief Compliance and Risk Officer as well. So we're going to start with a fire round where I'm going to ask you some questions, and you'll take it in turns to give a fairly brief answer before we go into an actual panel discussion. At what age did you save your first $10,000?
I think I was 23.
23, yeah.
I was
Can
24.
Oh, 24 as well. Okay, brilliant. Okay, and when did you start to feel truly confident about managing your finances? Uthra?
Confident. I think I'm comfortable, but
Confident?
I think in my mid-30s. Yeah, I mean, that's like 10 years of playing around and then get some confidence. Yeah.
And Amanda?
I think I'm okay. To be honest, I never feel fully confident. I'm always a little worried that it might not be enough. But I think I'm doing okay. I'm trying my best, essentially. I have my set amount and I'm working towards it. So that's a good start.
And what was your greatest fear when you first started investing?
Losing the money.
Losing the capital, yeah.
Okay. And what is your one hope that you have in empowering the next generation of women when it comes to financial planning and investing?
I think the biggest hope is that there's so much resources and knowledge that is available. And I really hope that people start early and take it in a more methodical way, because I did spend a fair bit of time dilly-dallying myself on that bit. So I think that's available today, and that's my biggest hope.
I think for me, it's to hopefully encourage women to just get started. If you look at the numbers in Singapore, 73% of women actually defer financial planning decisions to their spouse, which is quite a large number, a large majority of Singaporeans here. And, it might be, you might obviously be very independent and have it all under control, but based on that number, we have friends, family members that are probably not. So for me, it's to just hopefully, I guess, encourage people to just get started. Yeah.
Thank you. We'll move on to the actual panel where you can discuss amongst yourselves as well. I would like to know how you started incorporating a savings routine into your life.
Well, to be honest, savings was so integral part of my growing up. I came from a proper Indian middle class family where the only thing that I was taught about finances was to save money. So right from the time I was a child, I think that the piggy bank concept existed, and then we would just put whatever little cash that comes into it. So savings was always there as part of growing. And to me, I think the real change and understanding was, okay, what do you do about the savings? You got to invest it. That was my bigger point or bigger moment, but savings was quite a habit.
For me, I probably shouldn't say this, but I think I enjoyed myself a little bit too much in my early to mid 20s. So I didn't really start saving until, obviously after that. But for me right now, I think what I try and do is, mentally, if I see it in my kind of savings account, it's very easily accessible, and I will spend it. So what I try and do is that the minute my salary comes in, I have actually an automated transfer to a separate account within the same bank, which mentally I know I cannot touch that any money in that bank account, right? So I have a set amount that I can actually use as expenses every single month, and for me that just helps. I just automate that process a lot, and then from that second account, I have sending instructions to my different investment account. It just makes it much easier for me. I don't have to think about it. And I know, very readily what I can actually spend every month as well. Yeah.
Yeah, I think once my emergency fund of the first 10,000 was kind of taken care of, I went on a travel spree for about 3 years. But, I think after that, it was really about when I wanted to think about, changing my job. I think that was the first time that then it hit me that, okay, if I really want to change my job, I need to think about going beyond my emergency fund. And so probably around like 27 was when, I started to do very similar to Amanda, which is just take it away of your everyday outlook. And the other thing which I did was to cancel my credit card.
Wise. Brilliant. And so when did you start taking investing seriously, and why, Nandini?
I think start taking investing seriously was, once my mortgage on my first apartment was, I was saving beyond what I was paying for the mortgage. I think I was now in my, I think 30 almost. And I moved to Dubai. And the first time it was that, I started to talk to the banks to say, okay, what is my money going to earn in the bank? And when I realized the interest rates, then I started to think about like, okay, I don't think I can take on another mortgage right now, so I can't buy another property. So I need to think of other avenues because it's sitting in the bank account was just not doing anything. So I think around 30 was when I was like, I have to really get into this.
Uthra?
I think I really started investing when I was in my first real job. I started off with HSBC Securities, which was a broking house. So the environment dragged me into the investment, and I was this compliance officer who would be approving investments of internal staff. And I would see that the market was too volatile at that point in time, and India was going through a growth phase at 6.5%, 7% GDP growth, and then everything was about market and the environment rubbed on. So I did my first plunge in 24. And
I was an engineer, so it took me longer to get my head around it.
I'm actually the opposite from that. So I studied finance in university. I came out and I worked for Citi. And so I was around investments. But because of, when you work in a bank, and I moved on to a multifamily office, when you work in a bank and environment like that, every single trade that you make, you have to put it through compliance. And it is quite a hassle. So for actually a good amount of time after I graduated uni, when I started working, I was just so busy and I didn't want to fill up. The form is quite extensive actually. So I didn't want to fill out all of that form. I actually made the big mistake. It's also one of the biggest regrets of my life. I just kind of just left it in a savings account and had just a couple of ETFs. I do wish I kind of took it more seriously much earlier on. So for me, probably, just I would say 6-7 years ago was when I actually took it seriously. Yeah.
Thank you. And I'm sure you've made some mistakes along the way in your investment journeys. Can you tell us about any mistakes you've made? I know I certainly have, but maybe you have.
Well, yes, there is always mistakes and there's always a little bit of burning that happens, and that's the way you learn. To me, I think the biggest mistake, or rather the regret, is at one point in time when there were these products called ULIPs, unit-linked investment products, which is nothing but a combination of investment and insurance. At one point in time, it was the biggest thing that came in, and I put money into it, and I just realized over a 2-year period that this is like the biggest blunder. And I learned it the hard way after losing 30% into what I do not know, because they were hidden fees. I mean, I don't even know the calculation. That's what rubbed me off. And then I pulled out all the money at it and booked the loss. And then I went to learn and read about it. So that's when I realized that the biggest mistake is to commingle your investment and insurance decision into one pot. They're meant to be completely for different purposes. They're meant to serve different goals, and they don't work together in that sense. And then it's so, when they're integrated, it's complicated. So I just decided that I will always keep my insurance and investments separate.
For me, it's not starting investing earlier, but this other one that I have is not actually, it's more so, in Singapore, a lot of our parents actually, like to invest in endowment policies and investment linked policies for us. So I had one from my mom, and obviously, from their point of view, it's they really want to help us save and then leave something for us. And, obviously they have good intentions of doing so. But when I started working and obviously being in the industry, I know I'm not a big fan of investment linked policies personally, and what Uthra just mentioned, keeping investment and insurance separate. So I actually did the math of how much fees we're paying as well as the level of returns, and decided to actually cancel the investment linked policy. So we lost a lot of money, but I think we have lost more had we just continued on. So yeah, that was one of mine as well. Yeah.
Yeah, my first investment was actually a mistake. So I had moved to Dubai, and at 30, when I did look around, and there weren't at that time self-directed options. We're talking good almost 15 years ago. And I got in with a fund, which was you have to put monthly recurring. There is a 15-year lockup. I am still 2 years to go on that lockup. Sometimes you pay for them for a long time. And yeah, I mean, looking at then the fees. So I've always obviously been through 3 market crashes, start from 2000 all the way to 2020, 3 big market crashes. The 2008 one was not fun when your investments are not doing well. You cannot understand more. You see fees going out, which is totally disproportionate. And you still have, at that time, I still have a 10-year lockup ahead of me. So yeah, lockups and the fee combined, they are a big part.
Yes, definitely. And so how did you guys gain confidence in managing your investments? And we've had a few questions as well from the audience listening in and watching us. If we're not supposed to time the market, then what do we look for when we want to invest in the long term? And what resources do we have that you guys have used, for example, to gain that confidence in your investment journey? Amanda?
So I think the best way to gain confidence in investing is to just try, right? And the great thing about, I think, digital wealth managers in general is that the minimums are very low. So for example, StashAway, you can get a portfolio with, $10 US. So, just try with a small amount. And then as you gain more confidence, you can always invest more, right? And I think that's the best way. It's just, at least get started and try it out. I think that would be the main thing I would recommend.
I think the second part is really, just to ask a lot of questions. And if you feel that your questions are not being answered fully to your understanding, you are not the problem. It's who is answering is the problem. You should take your questions to another fund manager, another, financial planner, and ask them the question. So I think a lot of times where people get stuck is that they get very convoluted answers given to them, and then they feel that, oh, I do not have the capacity to understand this. Therefore, either I just trust this person implicitly and I just have to go ahead with it, or I just should not be here. But if somebody is explaining it to you in a way that you can't understand, you are not the problem. And therefore, you can get to a lot of resources, a lot of answers. And now, there are a lot of independent bloggers, who pay a lot of attention to their audience. So, find one whose tone of voice really speaks to you and build your knowledge through it.
And we actually have another question on whether you have suggestions on free resources related to financial planning for women, YouTube channel, books, etc. I guess one of the things we can recommend is, of course, our own academy as well. Amanda, any other resources you would recommend?
I would recommend StashAway Academy. No, I'm sorry. Nothing really comes to mind. I do read a lot of articles online, a lot of media articles, but I do try and read it with a pinch of salt, as I mentioned earlier, right? Sometimes the media likes to sensationalize the news that you read, but I think there are a lot of free resources out there, even on like CNBC and Bloomberg, that just helps you learn. But obviously form your own opinions after that, and yeah, I think, look out for resources like StashAway Academy that, helps. It's obviously, independent in the sense that we don't actually talk about StashAway at all in these academy sessions. So if you're interested to just dive deeper on financial planning and investing, you can attend the sessions live or actually watch it on our app for free.
Thank you. Another question from me, talking about partners and family. So Uthra and Nandini. How do you financially plan together with your partners?
Okay, to be honest, I was quite active on saving and investments right from the beginning I started my career. But to be honest, the actual planning and methodical or more systematic approach, I really started 3 years ago when our child came into our lives. So that's when it was like, it dawned on me that it's more serious and the next 20 years means a lot in terms of a lot of areas. So that's when I really sat to sit down, put numbers and put a goal and all of that. Though I had understood all of this, but it would more so be that I have a certain amount to be invested. I will allocate it across few assets, and that's about it. Because the goals still then were retirement, okay, and then I wanted to travel here. I wanted to do these kind of things. Suddenly, the goalpost started to become really serious and more real. So now what we do is that we have a more systematic way of looking at our finances, and we have quite objective based diversification between the two of us. So my husband typically focuses on the retirement goals, and I focus on my child's education and growth. It's also that way because our approaches to investment is quite different. So we didn't want to have a clash around that or have too much arguments. So it's like, okay, let's try both ways. Your approach, my approach. We just review our investments once in six months, or if there is really some big event, like if we had a good bonus or we want to really increase or top up or do anything that way. But otherwise, once in 6 months, we look at it, and I mean, you may have to take some shifts and adjustments and calls, but probably it's more around, to see how they're working. And I think when you talk about long term, it is about the long-term horizon, and something that's got a bit disturbed over the last 2 or 3 months shouldn't really impact, and that shouldn't panic. And that's the way we look at it, because we're talking about the next 25 years. So that's the way we've been planning our. It's very simple. It's retirement and child's education. Yeah.
Yeah, I think for me, it's I mean, the first thing is to align on the actual goals, and the finance part is a means to it, and especially for kids, I think we really had to come to a decision or agreement on what do we provide for the kids, and we had to agree on that. Are we going to send them to a $40,000 a year university, and you have to say yes or no? Spoiler for my kids, it's a no. And accordingly, then you say, okay, this is the goal for the kids. This is what we want to provide for, and this is what our own lifestyle needs to look for. So I would say, as Uthra said, then the planning and everything can happen, but I think you need to align on the goals and what do you want to provide for your kids, and be aligned on it.
Thank you. And I'm just going to ask Amanda this. Amanda, what do you look out for when you're considering investment opportunities for the long term? Anything specific?
For the long term, I think generally, as I mentioned earlier, I do try to take on I'm a bit more aggressive because I know, I can ride out any recessions that might happen over the short term. So I probably look at things that has a higher expected return, might be a little bit riskier, but still making sure that I'm comfortable with the level of volatility that I might see. So for example, I'm not going to put the majority of my net worth in crypto, right? And also probably think about the amount of fees I have to pay, only because I know, obviously seeing a lot of investment products, what are certain benchmarks that I am comfortable with and not comfortable with. And so, these are just certain numbers I look at. I probably also look at, if I'm, let's say, drilling down on particular investments, I would avoid things that are not very liquid, not very actively traded, just so that I make sure that, I can get a decent kind of spread for it as well. Yeah.
Thank you. And for all of you, what steps are you actively taking right now to plan for retirement? Or prepare for retirement?
I'm actively a passive investor now. I played the market in the first 5, 6, 7 years. Then I started to drift towards a very mutual fund based thing. And I started with the discipline of investing into a systematic investment plan. And I'm lazier now to even do that. So I kind of look at broader ETF based segments. And that's over a period of time, I've learned that passive investing has really grown on me. With multiple things that's coming your way, with a job, with kid, I think this works best. So I am an active passive investor now. I look at broadly 3 segments. I am a fan of US equities. I think that there is no place without US equities and that market performing in the long run. So I allocate a fair bit into that. A big fan of the Indian market. I understand that market, and if it's supposed to become the third largest economy in 20 years time, then it is fair for me to allocate it into that market. And then the rest of it, I am generally looking at global portfolios, and I'm more a portfolio based. I don't do direct stocks anymore, and then I do play a very tiny amount, less than 5% on ambitions that have not gone through, rabbits that haven't even gone through. So maybe with respect to higher risk, cryptos, and all the fancy things that come along, that's just to get oriented and understand and get a feel of that. So that's typically how I do my investments now. Yeah.
Thank you. And Nandini?
Actively on my retirement, actually right now, because my retirement is not that far away, it is to finally decide where and get the house now. So far, any real estate investment has only been as an investment, not so since it's less than 10 years away, I do now start to think about the real estate part of my retirement more seriously. Yeah.
Yeah, and that's quite important as well when you're planning for your retirement, to actually think about where do you want to retire, because the money you're going to need is of course going to be dependent on where you're retiring. Amanda?
For me, I think, investing more regularly. So what I mentioned earlier of automating that is a step that I'm trying to actively follow. I did make a mistake back in February of 2020, where we actually got our bonus. And what I did was I put the entire amount right away, invested into one of our highest risk portfolios. And then if you remember, in March 2020, the market crashed and my heart did ache quite a bit from that. But I stayed invested, so I'm quite happy now. But that's a lesson I learned, right? Meaning, if I get my bonus, I am no longer going to do a lump sum, but actually really dollar cost average into the market, which is actually what we preach, and I now definitely follow it.
Brilliant. Thank you. Okay, so last question from me, and then we can take some questions from the panel, from the viewers as well, and maybe from you guys. If you were to share one piece of advice with people who want to start today, what would it be?
I would say start today if you haven't. There is no one good day for that to happen. Whatever is the amount, that shouldn't be the problem. It can always increase. You can adjust it. Just start today, look long term. Yeah.
For me, I think definitely the same thing. It's the same thing as people saying, I'm going to go to the gym next week or next month. It's never going to happen unless you just start today. So definitely just get started and make sure that you avoid. A lot of times when people start, I think they choose one particular stock to go in because that's, how they begin. I'm going to maybe invest in an Apple stock. And that can be very, very dangerous because, you're obviously very exposed to just one stock. And we saw with Meta recently, the dangers of that, right? So if possible, try and find a platform where a very low amount, you can actually get something that's very, very diversified. And I think that is very important, especially over the next few months with inflation. Markets can potentially be very volatile. So just make sure that you are very diversified.
Yeah, I mean, I would say don't underestimate the power of even the first $50. Like when you will look back in 2 years, 5 years, 10 years, the power of that first $50 is compounded disproportionately, not just, what it becomes, but also putting that $50 there, what it will push you to continue to pay attention to read more things, to just be more engaged. For me, the power of that first $50 is just disproportionate over the long term. So, yeah.
Thank you so much. Thanks for that. If you don't mind just sticking around a bit longer, I'll ask you some questions from everyone watching, who's been watching Amanda earlier, but also this panel. So someone's asking, anonymous, how often should I review my financial plan? Amanda?
First of all, annually for sure, or
Yes.
whenever significant life events happen. So as I mentioned earlier, if you get married, you want to make sure you update your financial plan and perhaps talk about it with your partner, because it starts to, obviously be something that you want to talk about together when you think about your retirement. So yeah, in short, definitely annually or when, major life events happen.
Thank you. Someone is saying, I can't seem to stick to a way to track expenses. Is there an app to recommend or Excel? How frequent should we update and review expenses?
I would actually say paper and pen works great. I mean, I have not used an app ever. And if apps are not helping you out, just take out a paper and pen. You actually don't even have to note down everything. Like, I actually really love the Japanese method, which is just divided into 4, which is your needs. So, the food that you eat, the roof over your head, and the public transport that you have to take. And then you have your education, your cultural, and then your miscellaneous. And basically, I really love that method because it allows you to say, I don't want to think of, developing in my culture or my education as something which is frivolous. So you do want to make conscious decisions around your own development. And I actually really love that method. And so I've usually used like a notepad, which has like 4 just big spots. And I just put the amount over there. And I don't even think about putting every time, where did I spend? But it's only that when I see that, oh, miscellaneous, 1 year went way too high, then I will say, okay, for the next month, I will track my miscellaneous more in detail to understand where is it going. So actually don't think about expenses as if you don't track every cent, you are actually not tracking your expenses. I think even if you start with big blocks, you'd be surprised at the patterns it can reveal for you.
Yeah, absolutely. I would probably personally recommend Excel or maybe an app. I'm sure there are apps.
I think there's one called Wally.
Okay.
Can use that.
Yeah. How frequent should we update and review expenses? I think at least the first time is probably the biggest shock you'll get when you actually sit down and look through your bank statement and realize what you spend your money on. Amanda, how often would you review your and update your expenses?
So I think the way I do it is I honestly try and use my card as much as possible, so I don't have to think about it too much. I know people that actually have the Notepad app open on their phone and use that to track the cash expenses. I kind of don't really use cash a lot, so I just use my credit card statement to kind of base it off my expenses. And I think that might be the easiest way to do it. Or don't use a credit card, use a debit card if you don't have one. Yeah.
Thank you. Someone is asking, any tips for people who are going back to school for career change and have stopped full-time job? Any tips on how we should continue to build wealth? Uthra?
Well, I guess one thing for those kind of people is to be conscious about the expenses first and foremost. It's a conscious effort and a mindset to say that, well, I don't have my regular income from my job, so I just have to drift a little on how I spend. That's one thing. And I would believe that before the person was really gone into the university, they made up savings. So the best way to look at that is to put that savings and try to generate some regular income so that it kind of complements the expenses that you have to incur while you're at university. So those are some of the very basic things that a person can do even without a job at that point in time. And of course, then you also always have these part-time jobs and stuff that happens in university if you want to really supplement and not look into or touch into your savings. So these are some of the things I could think of.
Okay. Someone is asking what are the different asset classes? How do we know whether we have enough diversity in our portfolio?
What are the different asset classes? I mean, just to name a few, there's equities, you have fixed income, you have gold, you have real estate. We do talk about it extensively in our Investing Basics Academy course, but high level, I think the best way to think about it is just to make sure that you try and have at least perhaps 7 to 9 different asset classes in your portfolio. For us at StashAway, how we get this diversification is through exchange traded funds. So you have one ETF, hundreds of securities in there. ETFs represent an asset class on its own. So for a lot of people that perhaps don't have a large amount of capital to invest, ETFs might be a great way to get started. So instead of investing in one security, you have one ETF with a lot of securities, hundreds of securities in there.
Thank you. And how does pregnancy and motherhood affect females financially? Nandini?
I think it's such a personal journey. Obviously, for some people, taking time off, whether they want to, whether they don't want to, sometimes it's a choice, sometimes it's not a choice. A few really key things is, if you have been working before, you obviously, have to, if you decide to take a longer time off and, you don't have coverage for that time, legally for more than 4 or 6 months, that is from a government, then you have a loss of income within the family. But I think the second part is also, I think you pivot so much of your attention to away from yourself, not just from an income perspective, but just paying attention to how you are growing as a person yourself. You're totally into how somebody else is growing, and I think that does have an impact. And so, I would usually say, don't look at only the finance part, and then when you come back, we are sometimes just expected that, whatever was the time we took off from paid workforce, I would say, because we are still in a workforce, from paid workforce, then how do we come back into it? There's just so much question around what is the way to enter, and a lot of times there is not a very clear way to enter if you're deviating from a government stipulated maternity leave, right? So I think, and the part which a lot of people don't pay attention to is that during that time, how you have, or how you feel you have, or you haven't grown as a person actually does accumulate, and not to discount that as well. I do think that we continue to grow because taking care of another person is not exactly easy. I mean, you learn soft skills which should be put on CVs, and I think we've talked about this in one of our seminars a while ago, which is that I would love to see people actually putting motherhood on CVs or taking time off to take care of families on CVs. Because there's just so much soft skill development that happens during that time, and it's not to be discounted. But yes, there are important financial repercussions to taking time away from the paid workforce. And I think having a very clear discussion around it with your partner before, and what how you feel about it, and how do you make sure that you come back to a place of confidence is really, really important.
Thank you. Amanda, maybe I'll give you this one. How do you balance the occasional splurge with your retirement goals?
I feel a little attacked. So I think what I mentioned earlier, like I do have that set budget in a way of how much I can actually spend every month on things that I want. And I do so via knowing what I have in that expense account, so that savings account that I have. Obviously, I have set expenses like utility bills, Wi-Fi, my mortgage that I have to pay. And I know, on average every month I'm able to spend this amount. That helps me keep it under control, I think. So having a set budget that you're comfortable with, but also if you do overspend, that's fine. Maybe try and make up for it over the next couple of months.
And what's your opinion on physical investments? So wine, watches, Amanda?
I'm a big fan. So I recently started wine investing. It's actually done very well. So I'm very happy with it actually. And the great thing about wine investing is that, if you ever want to, or the wine investing market is not doing well, you can just go get the wine and drink it, right? So if you're sad, you can drink it off, which I really like. Yeah.
It's a very liquid investment.
It is a very
All right. Another question here. Amanda mentioned earlier in her financial planning section to pay off the debt as quickly as possible. What if the debt is interest free? Should we still pay off as fast or keep some to invest?
First of all, wow. I mean, that's amazing that you are getting an interest-free loan.
Where can we get that?
Nothing is free though. So I would say just make sure you kind of look into that a little bit. If it is really an interest-free loan, I think, yeah, I mean, if it is interest-free, then, you can potentially take advantage of actually investing that amount and making the margin. But then you need to think about whether that loan actually has a timeline and a deadline in which you need to pay off, and just make sure that you do that in a timely manner. Yeah.
Okay.
I think if I could just add to what Amanda said, another way of looking at it is that instead of paying the EMI to, even meet the principal, forget the interest for now. If you can pay it off and then use that money to invest, there's probably an opportunity gain that you would make. And that is the way you should evaluate it from a pure mathematical standpoint. Yeah.
Okay, I'm going to combine a few questions here and we keep getting some. How do you estimate how much to set aside for your goals? And how did you weigh out saving for investing for retirement and buying a house? And what is considered a long-term view? Nandini?
I think the first part is about how do you set for different goals. I think the first part is, remember, as Amanda had shared, retirement is the most expensive goal that you have to save for in your life. And I mean, already in our generation, we have a 50% chance of living to 100. That's a scientific fact. So if you are in your mid 30s to mid 40s, you have a 50% chance of living to 100. Anybody who is under 35 has a higher, I believe it goes to like 65 or even touching 70% chance of living to 100, which basically means that, if we continue to think of retirement age as 60 or 65, the overall cost of the retirement is continuously getting more and more expensive with life expectancy growth, which is great, but it has its pieces. And so I think it's most important to think about, like, from your salary every month, to pay your future self first. And to actually do that that calculation is how much will you need. A lot of people think, oh, whatever I spend today is what I will need in my retirement. No, actually you won't. There are a lot of things that you spend on today that you won't need in your retirement. You won't be going to an office every day. Your transportation costs are different. You should think about the space in which you want to live in. You have to think about your daily things. When we are younger, our expenses look very different. Usually, I think what we recommend is that it usually comes to about 70% of what your costs are of a single person when you are younger. That's what you need for your retirement, not the 100%. And so I think you really have to first pay yourself. Between long-term and short-term, goals like retirement and buying a house, I think, again, if you are buying a house to actually live in it, and mortgages are good value today, and as a long-term debt, it's probably the debt that you don't need to pay off faster. It's really important, again, to start it earlier, because it gives you if you started much later, you might not be able to get a 30-year loan, which reduces your every month's EMI, which means more money is available for investing in a better return than what a mortgage takes or what real estate value goes up. In certain countries, it might be the opposite. Like if you're living in a country where real estate is absolutely just booming away, and that's going to happen for a while, which none of us can predict, then it's different. But in Singapore, if you're buying a house over here, it's what you will live in later on, but it's not going to beat a 6% or 7% market rate year on year. So starting early means you can have lower EMIs because you can take a 30-year mortgage and make sure that you start on your long-term goal sooner rather than having to put way too much in your short-term goal. So I think mix it, look at your mortgage rate, look at the time frame, and again, long-term investing, 30 years, it's a really long time just to compound. So again, the $50 even would be great.
Thank you, Nandini. I'm going to wrap up the questions we've been given here. I hope I've covered most of them. If not, please reach out to us and to our support team, and we'll be happy to answer those questions that I've forgotten or missed. Sorry about that. And I'm going to wrap up with this. What is the difference between thematic portfolio investing versus general investing versus StashAway Simple?
Okay, so thematic portfolios are actually a lot more focused on a particular sector and a particular theme. So if you have, for example, an opinion where you think perhaps healthcare innovation is going to be the next frontier and you want to get exposure to it, we have, portfolios that are focused on that particular theme. Our general investing portfolios are actually our kind of most popular portfolios. It's really globally diversified for anyone that's looking to really just get started and start growing their wealth. It's a great portfolio to help you get started. There are 12 different risk levels for you to choose from the lowest risk, which is equivalent to a 95% bond portfolio, to a highest risk, which is equivalent to a 100% equity portfolio. So it's very globally diversified. StashAway Simple is our cash management portfolio. So this is for you to manage your short-term cash needs. Right now, for example, cash that you have in your savings account, it's probably earning very low interest rates, not beating the rate of inflation at all. So for example, a lot of our clients do invest some of their cash savings in StashAway Simple, where they get right now a projected return of 1%. So it's more than what you're getting in your bank savings account. So at least have maybe 1 to 2 months worth of expenses in your savings account. For the rest of your emergency fund, you can consider StashAway Simple. Yeah.
And then maybe, Amanda, just to add to that, someone is asking, is it safe or better to invest in StashAway and not monitor it regularly? How best should we approach when it comes to monitoring our investments? What's the best approach? Should we be monitoring our investments? How often should we be doing that? And should we be doing it?
We actually did a report on this StashAway Insights 2020, where we looked at people that, how often did they check their app? People that actually check their app least often actually saw the highest level of returns. And I think, the reason for that is that people that do check their app quite regularly, potentially you get a little bit trigger friendly, right? You start to get a little bit panicky. So if possible, try not to look at it. I know it's very difficult, but try and avoid looking at it as much as possible. It is meant for, the medium to long term. So, just keep that in mind. Yeah.
Brilliant. Thank you so much. Thank you for taking the time.
Thanks very much.
Yeah. Thanks for coming, everyone.
Thank you, everyone. So basically what you can do is, if you have the StashAway app, or if you don't, create an account under the promotions tab. You can enter the code that you see right there, SheInvest 2020. You get 2 years of free investing on your next deposit. So you can just enter that code right there. And also, this is the first session of our masterclass series over the next couple of weeks. We will be having 3 more sessions as well. The next 2 would actually be held in Hong Kong. But for those of you that are tuning in from Singapore, you can watch it on Zoom. We'll be talking about investing in your beliefs with thematic investing, and also actually touching on crypto and NFTs. So I know this is something that everyone's talking about right now. If you have no clue what it is and you want to learn a little bit more, you can attend that session. And then lastly, we have one more session that's happening in our office in March, actually in time for International Women's Day. We'll have Nandini, who's going to be moderating a panel. She'll be joined by two very senior ladies in the financial services industry. And so, yeah, you can join us for that session where we talk a little bit about investing in female leaders. How can we look to empower women to obviously move up in their career path. So yeah, you can join our follow our Eventbrite page and sign up through that page. Thank you.